Hey everyone, happy Saturday, December 21st, 2022, the last day of the year. And it's time for another episode of Mayhem in the Markets, brought to you by TraderAid.com, your source for fundamental, macro, and technical analysis, as well as educational resources on trading and investing. First chart we have here is from Goldman Sachs. The financial investment house expects negative core goods inflation next year, which would make sense because we are looking at some pretty high comparables. If we go back and look at where we were in 2022, we could see some serious disinflation, maybe even, as Goldman expects, some negative inflation or deflation. And after so much demand was pulled forward from the last 2 years, it would make sense to see some deceleration in demand, and that could lead to lower prices, particularly in a more difficult economic environment, which is good news to be sure. But the bigger concern will remain services inflation. OJ really ran in 2022. This time not in a Jeep, but the actual juice itself up 45.73%. This was really impressive performance. I'm sure some folks got pretty good exposure to orange juice and made money. But overall, even heating oil, rough rice, and natural gas were very interesting places to play. Volatility didn't perform quite as well as many may have hoped. Getting exposure to volatility during a bear market really didn't yield the types of returns that we may have seen in years prior. But nevertheless, orange juice, a standout. You can almost see that scene from Trading Places where Dan Aykroyd and Eddie Murphy are basically putting on a huge winning trade and celebrating. Looking at this chart, I'm sure some folks had a similar celebration this year if they had OJ exposure. And the question now is, have we seen peak oil? The discoveries are at the lowest level since 1946. This is a bit of an issue because we're not seeing the kind of discoveries we would need in a world that's still increasingly dependent on hydrocarbons for transportation and other forms of energy, as well as for chemicals, for fertilizers, for plastics. We need more oil. We're not moving towards a renewable future that can replace it at any reasonable scale. Part of that has to do with the fact that there's simply not enough grid capacity to replace a lot of internal combustion engines. But the other part of it has to do with a lot of these policies that have served to discourage investment in oil, and a lot of the underinvestment by companies in exploration are coming home to roost. 10 years of chronic under-exploration is starting to paint a rather unpleasant picture. The ratio of proven reserves to production is at the lowest level since 2011. And supplies are an issue too. When we look at storage in the United States, supplies are, I believe it's the lowest level since 1986 when you factor for SPR as well as commercial storage. Other countries aren't doing so well either, with their oil storage at levels that we haven't seen in about a decade. So I would be a little concerned if there's any kind of meaningful disruption in oil, we could get back to triple-digit pricing pretty quickly. And if estimates for 2023 are accurate, they show demand outstripping supply by later in the year, which could lead to meaningfully higher oil prices as well. So not just a disruption in supply, but also an increase in demand. Now imagine if we get both at the same time, that could paint a pretty disorderly upward price discovery picture for crude. 2022 was indeed a year for the history books. The number of days where the S&P 500 closed down at least 1% was almost 1 out of 4 trading days this year. This was the worst showing of strength since 2008 during the Great Financial Crisis, where we saw 29% of the trading days have 1% declines or more. Falling skew often doesn't lead to positive outcomes over the course of 2022 and even late 2021. Now, what this is showing us is a market that is less hedged and also those that are hedgers taking off those positions. This is not what you want to see, although I know a lot of this options activity in SPX has moved to 24 hours or less, with 44% of the volume trading in those options expiring within a day or less. However, we're still not in an environment where we can say the market is well hedged to absorb some kind of exogenous shock. That fattens left tail risk, which could lead to more pronounced downside. If we have something happen that the market's not expecting, it could really come as a shock. And because participants aren't well hedged, they may have to liquidate components of their long portfolio, where hedges may otherwise have been able to help to absorb that blow. Households own 37% or $63 trillion of the U.S. equity market. Now, a lot of this is upwardly distorted. That is to say, the 1% and 0.1% of America own the vast majority of stocks, over 80%. However, it still also demonstrates that there is a lot of equity exposure by households, including retirees and investors that are upper middle class and middle class. And typically during a recession where a bear market is happening, we see a large cash raising event. We haven't quite seen that yet. We have seen more hardship applications due to inflation for withdrawals and loans against 401ks, but we have not seen a real cash raising event by retail that would tell me the worst is over. We're seeing some signs, but not quite enough. So that first sign is the largest outflow on record from equity ETFs. These passive flows rose significantly before we saw this recent outflow. So the outflow is actually dwarfed by the inflow that preceded it, which tells me I'm not going to take this too seriously, but I do think it's worth watching. If we see continuation here of passive investing starts to see some significant outflows and not a resumption of these powerful inflows, then I would say maybe, just maybe, we're getting closer to that point that folks are getting worried enough to exodus in mass some of these stock holdings, to really start to look at things a little differently and worry a lot more about risk than potential reward. While sentiment has been terrible and people have been the most bearish and by some of these measures ever, or at least since the great financial crisis, that doesn't tell us that a bottom is in. What tells us that a bottom is in is when positioning and flows significantly change. So we're seeing some initial signs there, but again, not enough and not for a long enough period to warrant any kind of attention other than taking a note. Moving on, we also saw investors ditching stocks at a record pace globally. Once again, this is a first sign. I think it's helpful to see it. I don't think it means that a bottom is in. I think instead it's telling us that perhaps we're at the beginning of that cash raising event, something we're going to want to pay particularly close attention to in the first half of 2023, because we have a Federal Reserve that is still hawkish and aggressively running down their balance sheet, raising rates and planning to keep them at a higher plateau. And they're joined by other central banks like the ECB and even Bank of England that are relatively hawkish. They're running down their balance sheets, they're raising rates, and they're taking a more aggressive position to try to battle this seemingly intractable inflation. And while we're seeing signs of inflation ease on the goods side, we're not seeing that same easing on the services side. And that's really the biggest problem, because inflation like this on the services side tends to be more sticky. So with Fed hiking and ECB hiking continuing into next year, that's likely to put additional pressure on the equity market, which could cause us to finally get to that point where there's an event where people do really exit equity positioning en masse. We start to see margin debt come down, peak to trough by over 50%, which I think we need to see. And then we eventually see that Fed turnaround. But remember, when the Fed first starts cutting, when they first start easing, that isn't necessarily the end. So I do think it's important to look at just where we are in this cycle, that we have some room to the downside potentially. If this is like any other time in history, the market could continue moving lower before we find an ultimate bottom. And looking at these flows will be important as one of those indicators that maybe we're seeing some exhaustion in that selling. But we're not there yet, in my humble opinion. Retail investors' average daily net purchases of U.S. securities broke records in 2022. And this is why I can't say we're there yet, because we still see this optimism, this relentless dip buying, and that's not a sign that the sort of reflexive buy the dip or in a permanent bull market mentality has ended. Quite frankly, a lot of people, especially in their 30s and younger, have never really experienced a financial crisis or a meaningful recession or a big bear market. And they're getting their taste of that in 2022, but there's still this reflexive buy the dip, the Fed's going to pivot at any moment kind of mentality that I think is undermining their ability to see the forest for the trees, which is that we're still within the context of that same environment, and a pivot to mean Fed easing is not coming anytime soon unless something really big breaks, and I just don't see that happening yet. The semiconductor glut is becoming a big problem, and we can see this in desktop GPU sales hitting a 20-year low, which just adds to pressure because there's going to be a lot of excess inventory from the manufacturer level to the distributor level to the retail and e-commerce level. This is likely to put further negative price pressure on video cards and other accessories, as well as CPUs, and in general gadgets. Now, the big problem here is that a lot of these semiconductor companies went into overproduction, or at least tried to improve production when there was a crunch. Now we have the opposite. We have a glut because not only did they produce more, but people want less. A lot of that consumption was pulled forward. So we had really high demand in 2020, 2021, and part of 2022, and now it's fallen off a cliff because everyone has a new video card or a new computer or a new gaming system or a new phone, and few people are refreshing, and those that are likely extending their refresh cycle if they're an average consumer and they're cash constrained. And I want to wish everyone a happy new year for 2023 and let you know that we've got 30% off any plan at TraderAid.com. Use the code HOLIDAY2022. The offer is good until January 2nd. Check it out. We've got plans for just access to our website as well as access to our website and our Discord. And we're focused on education. We're different than other services because our goal is to try to prepare you to be a more consistent trader and investor during this most difficult environment in the market. This is the most important time to improve your skill set, because if you can survive and thrive here, you can survive and thrive in any market. So check us out, TraderAid.com, to learn more. Back to the charts here. Amazon over invested in capacity. This is more of an article than a chart, but basically it's illustrating a very important point. That while there was this supply chain tightness and this big lurch to buying goods via e-commerce, Amazon overestimated the durability of that trend, and they also overestimated the amount of demand growth that they would see in the near term. So e-commerce buying goods has fallen, and so with it, we've seen the demand for Amazon's transportation capacity fall. Now they're starting to say they will give space on planes to others. They will sell that space, basically becoming a long-haul transportation company to some extent. This is very interesting to pay attention to, in my opinion, because not only could it give some more competition to others like FedEx or UPS potentially, but it also shows that during these types of whipsaw cycles, a lot of companies over-prepared, and then they had an economy that under-delivered. And Amazon's not alone. FedEx has seen similar struggles where they've had to idle a lot of their capacity because demand for goods being shipped fell quite a bit. Liquidity is being drained around the world by aggressive central bank policy, tightening financial conditions, and that leading indicator, that Nordea Global Liquidity Indicator, is suggesting that earnings may have to fall quite a bit. Now, to what extent, that remains a question, but it is likely that we will see something resembling an earnings recession in the year ahead, something my partner Aisha has talked about quite a bit that I think is important to explore, because what it really means is the bottom line of these companies are going to contract sequentially during an environment where disinflation or deflation can put more pressure on these companies in addition to likely a slowing economy. The combination of those two things is like a vice where it could slow both top and bottom line growth, as during a price environment where prices are either rising at a slower rate or falling, a lot of companies tend to struggle more than in an environment where they're rising at a consistent pace. Dollar already yields more than 56% of global currencies. And this is one of the reasons that the dollar had such a powerful rally in 2022. And it suggests that we could have more to go, as we know the Fed is not done hiking yet. So something to watch in the year ahead is really the relative rate disparity between the United States and other countries around the world. As long as the US dollar is yielding more than other currencies based on the Fed funds rate and versus other central bank policy rates, it's likely to enjoy strength. Once we see the Fed finally start to cut aggressively, which is likely to happen eventually, this could all change quite a bit. But for now, this is creating problems because there's a lot of debt, over $100 trillion globally, that's priced in dollars and also uses U.S. rates like the 10-year as a benchmark. So with the combination of rising rates and an appreciating dollar, some debtors are looking for alternatives for where they're going to and how they're going to fund their debt. And similarly, we're seeing more of a search for alternatives for settling cross-border transactions because having an appreciating dollar has created more trouble, more harm than good. A lot of countries would rather see a stable dollar or a dollar that's falling modestly year over year. Bond liquidity is pretty constrained. It's at levels we haven't seen since really this whole period. If we take that out, we can look at 2021, we can look at the COVID crash, and we can look at some of these other prior periods of constrained bond liquidity, which adds to volatility. There is a pretty strong correlation between negative liquidity or liquidity falling and rising volatility. And in the bond market, this year's been no exception, with the MOVE index, the VIX for the bond market, reaching levels we hadn't seen since the great financial crisis earlier this year, showing us that an illiquid bond market is leading to very disorderly price discovery and, as a result, rates. And these rising rates put a lot of pressure on the stock market, leading to the worst year for 60-40 portfolios in nearly a century. Existing home sales are collapsing, and they're at the weakest level that we've seen in 12 years, sliding for a 10th straight month. This is not a good sign for the real estate market. Supply is also at about 10 months of supply available. This just tells us that A, there's not a lot of buyers, there's more sellers, and B, home builders are going to see, in my opinion, a much slower year next year. We've already seen that demand for new projects has fallen 17%, and projects in the pipeline that are backlogged have been canceled at a rate of about 23%, suggesting that 2023 is a year where their cost of capital will be higher, their business will be lower, and as a result, they could be seeing both lower top and bottom line growth or even deceleration across both. And finally, I just wanted to thank everyone for tuning in. This channel and my path really on Twitter, TraderAid, YouTube, and elsewhere is the path less traveled. I don't want to talk about the things that people want to hear if they're not appropriate. I want to talk about what could be difficult things to hear. So I know that this isn't always the most fun to listen to, but that's because I really want to concentrate on what I think is important and why I don't think we're through this difficult environment. Like everyone else out there, I have long-term investments as well, and I'd love to see them prosper. But I don't think we're in an environment where it makes sense to look for that happening in the near term. Instead, I think it's a great time to make a shopping list and look for lower areas, better prices, better valuations to start adding those positions. So I want to thank everyone for tuning in. If you like this YouTube, please like and subscribe and check out my work on TraderAid.com. Happy New Year, everyone. Wishing you a safe and prosperous 2023.